Hey everyone, welcome back to Corporate Dakota. Today, NVO just filed their 11K for the fiscal year ended the 31st of December 2025. And I am seeing some interesting shifts in their employee benefit plan investments. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a clear look at how Novo Nordisk's Puerto Rico 401k plan is performing, and there is a significant change in their Novo Nordisk A's common stock holdings that is worth digging into. Let's dive right into the numbers for the Novo Nordisk Puerto Rico 401k plan. This is a look at how much money was available for pensions at the end of the year. Looking at the end of 2025, the total assets available for pension benefits were just under $8 million, coming in at $7,988,454. That is a decrease from 2024, when the total assets were a bit higher at $8,389,639. So there was a drop of roughly $500,000 in the total assets managed for the plan. Now let's break down where this money is invested. Mutual funds are a big part of the portfolio, and they saw an increase from $3,113,400 in 2024 to $3,538,150 in 2025. That's a nice jump, showing more investment in diversified mutual fund options. But here is where things get really interesting. The holdings in common stock Novo Nordisk A took a pretty big hit. In 2024, the plan held over $3 million worth of Novo Nordisk stock, specifically $3,068,926. By the end of 2025, that number had fallen significantly to $1,942,691. This is a decrease of over $1 million, or about a 37% drop in the value of Novo Nordisk's own stock held within the employee plan. This could signal a deliberate shift away from heavy concentration in company stock by the plan managers or participants. Money market funds, which are typically seen as a safe haven for cash, also saw a decrease, going from $115,653 in 2024 down to $62,535 in 2025. This drop suggests that money is being moved out of these very liquid, low-return funds into other investment vehicles. One interesting addition is the notes receivable from participants. In 2024, there was $0 listed here, but by the end of 2025, there were $68,600 in loans made to plan participants. This indicates that employees are taking out loans against their retirement savings, which is something to keep an eye on. Now let's look at how the fund's value changed throughout the year. This section details the additions and deductions to the plan's assets. This is a tough one. In 2025, the plan saw a net depreciation, meaning a loss in the fair value of its investments, totaling $646,153. This is significantly more than the $194,850 loss reported in 2024. This larger loss directly contributed to the overall decrease in net assets available for benefits. On the brighter side, other dividends brought in $132,709 in 2025, up from $100,383 in 2024. This suggests the broader investment portfolio outside of Novo Nordisk's own stock is generating good income. Contributions are looking solid. Employer contributions saw a slight increase from $82,473 in 2024 to $86,702 in 2025. Participant contributions also rose from $81,456 to $82,776. So, employees and the company are continuing to put money into the plan. The amount paid out in benefits to participants also increased from just $146 in 2024 to $123,182 in 2025. This aligns with an aging workforce, or perhaps more individuals reaching retirement age and accessing their funds. Putting it all together, the net result for 2025 was a decrease of $401,185 in net assets, contrasted with a net increase of $125,401 in 2024. This overall decrease for 2025 is primarily driven by that significant depreciation in investment values, outpacing the additional contributions and other income. Let's touch on the plan itself. This is a defined contribution plan, meaning the retirement income depends on how much is contributed and how well the investments perform. It is for employees of Novo Nordisk Inc. working in Puerto Rico. Participants can contribute up to a certain limit on a before-tax basis, which was $15,000 in 2025 and 2024, and also make after-tax contributions. There are also catch-up contributions allowed for those aged 50 and older holder. The company itself contributes in a few ways: a basic contribution, a matching contribution for employee contributions, and a discretionary contribution. They are making basic contributions of 8% of eligible pay and matching 50% of employee before. Tax contributions up to 2% of compensation. A discretionary 1% contribution is also possible. Your stake in the company's contributions depends on how long you've been with the company. After 1 year, you are 33% vested, after 2 years, 66%, and after 3 years or more, you are 100% vested in those employer contributions. Forfeitures, which are basically unvested company contributions that employees don't claim, are not being used to offset plan expenses, which is good. This is where we see those participant loans we noticed earlier. The plan allows participants to borrow money with a maximum loan amount tied to their vested account balance or a set dollar limit, like $50,000. Loans for buying a primary residence can be up to 15 years. The outstanding loan balance at the end of 2025 was $68,600. With an interest rate of 8.5%, this is a new feature for 2025, as there were no outstanding loans in 2024. Here is a look at how they value the investments. They use a hierarchy based on how observable the market prices are, with level 1 being the most observable. For 2025, pretty much all of the investments measured at fair value are considered level 1. This includes mutual funds at $3,538,150, common stock at $1,942,691, and money market funds at $62,535. This means the values are based on quoted prices in active markets, which gives us a good sense of their real time worth. However, common collective trust funds are valued differently using their net asset value or NAV. In 2025, this amounted to $2,299,114. While these are still considered fair value, they don't fall into the level 1 category because their value is derived from the underlying assets, not directly from quoted market prices for the trust itself. This is an important section to understand potential conflicts of interest. Novo Nordisk Inc. is the plan sponsor and administrator, and Novo Nordisk A, the parent company, is also considered a party in interest. As we saw earlier, the value of Novo Nordisk A's common stock held in the plan decreased significantly. The fair value at the end of 2025 was $1,942,691, down from $3,068,926 in 2024. Charles Schwab Trust Company acts as the trustee and custodian. They received fees for plan expenses with $762 paid in 2025, down slightly from $539 in 2024. Additional advisory and managed service fees amounted to $2,114 in 2025 and $2,183 in 2024. These are relatively small amounts compared to the overall plan assets. Finally, let's look at the detailed breakdown of the plan's assets as of the 31st of December, 2025. This is a very long list of investments showing the diverse range of options available to participants. We see various mutual funds like Allspring Special Intel SMCPI with a fair value of $216,486, and American funds UPAC R5E at $237,422. There is also a significant holding in the Schwab S&P 500 Index Fund, valued at $991,387. This indicates participants are investing in broad market index funds. And of course, there is the Novo Nordisk as common stock, with a fair value of $1,942,691, mirroring the numbers we saw in the main financial statements. In total, the plan held $7,842,490 in investments, and adding in those participant loans, the total assets available for pension benefits came to $7,911,090. So, what is the story here? The big takeaway is the substantial reduction in Novo Nordisk's own stock held within the employee plan. This could be a strategic move to diversify risk for employees, which is generally a good thing, especially if the stock price has been volatile. The increase in mutual fund investments and the introduction of participant loans are also key observations. The plan itself appears well managed by Charles Schwab, with fees remaining reasonable relative to the assets. While the overall net assets decreased due to market depreciation, the continued contributions suggest employee engagement. The risk I am watching is how this shift away from company stock impacts employee perception and potential future stock performance, if the company continues its strong growth trajectory. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.